Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Hunsley, and joining me today is Gopi Karunakaran, the Co-Chief Investment Officer at Ardea Investment Management. Gopi, you work in an area of the market that used to be stable, but has seen some remarkably volatile price action, that's the bond market. And you said that central banks have become volatility amplifiers. They're kind of almost encouraging it. Why do you say that?
Yeah, so you're right. I mean, we've really gone from one extreme of ultra low rates, ultra low yields, low vol, to almost the other extreme through 2022 and still this year. So what role have central banks played in that? Well, it starts with inflation. So if you think about most of the post-financial crisis era, so 2009, let's call it up to 2021, central banks have two policy objectives. One is growth, or supporting economic growth, and one is price stability. Now, for most of that post-GFC period, those two objectives were broadly aligned in the same direction. Inflation was too low. What they did to spur inflation would also help growth, so it was an easier calculus. Then inflation showed up, and now those two objectives are going in opposite directions. The things that they need to do to bring inflation back down, like tightening monetary policy, stopping quantitative easing, those things can hurt the growth objective. So there's much more two-way tension, uncertainty, hence volatility. And that's why we have this view that they've changed from being vol suppressors to vol amplifiers.
Do you suspect we're now at a turning point for prices and yields?
So it depends. Well, the way I'll answer that is if you're asking about a turning point in the sense of direction, are yields going to go up or down from here? Honestly, I have no idea.
Sure.
That is a very difficult call to make,
Yeah.
and frankly, we don't, as an industry, do a very good job of making that call. Where I do think we are definitely at a, we can call it turning point or regime shift, is around volatility.
Yeah.
So I think structurally we've shifted to a higher vol regime in bond markets, and what that means is for any level of yield, whatever you think the yield's going to be, you should expect more price volatility around that level of yield. So if you think about it in, risk-return terms, more price volatility risk for a given level of yield.
But is that a good or a bad thing for your investment strategy?
So for us, it's good, generally speaking. What we do is quite different to traditional bond investing, which is really a lot about accumulating bonds to get that yield or that income. Whereas what we do is a very actively traded style of investing called relative value investing, where we need price movement. And volatility generally equals price movement. So on average, it tends to be good.
Yeah. So in terms of that increased volatility then, what evidence do you have of volatility actually increasing in line with central bank speak? And I think you brought along a chart as well that we might as well explain.
Yeah, so that's a simple one to look at. So what that chart shows you is a global government bond index. It's just a whole bunch of government bonds from different countries around the world, all put together in an index. And the line that you see on the chart is the price of that index. So just like an equity index. And you can see on the chart some of the fluctuations we've seen over pretty short periods, like over a month or so, or maybe 3-4 months. You're seeing sort of 10% type moves, which is really more equity style volatility, but you're seeing in the bond market now.
Yeah, all right. So that's the monetary side. Let's talk about the fiscal side, because of course issuance also plays a big role. It has played a particularly big role in the bond market's volatility over the last 3 years. So how does issuance influence your investing strategy?
Sure, yeah, so you're right, it's a big theme. Just the context to this theme around issuance is really, it started with COVID. So COVID happened, governments everywhere in the world engaged huge fiscal stimulus. Of course, that all needs to be funded. And then the way that government's funded is through issuing bonds. So bond issuance has ramped up dramatically across pretty much every developed market. And that's happening at the same time that the biggest single buyer of government bonds, i.e. central banks, are actually scaling back. So you've got this massive sort of demand-supply imbalance playing out through government bond markets everywhere. Why that's relevant for us is that essentially what we do at Ardea is we exploit market inefficiency. And that inefficiency arises because of temporary demand-supply imbalances. So all these bonds coming to market is creating a lot of demand-supply imbalances, and that is causing what we call price dispersion. Basically what that means is you see situations where two bonds in the same market, same issuer, quite similar to each other, are priced inconsistently with one another because of these demand-supply imbalances. And we can profit from that by essentially buy the cheap one, short the more expensive one, and wait for prices to realign.
Okay, so let's talk to the dispersion then and the mispricing then. How active does your investment style have to be? And I guess how many trades are you also making in a week, given how quickly markets can now move?
Yeah, it's very active. So It's kind of the polar opposite to a traditional buy and hold style bond approach. With that type of approach, most of your return is coming from just holding the bond and earning the income or the yield that you get from that bond. Whereas for us, the income or yield is sort of irrelevant to what we're doing. It's all about price movement. So all of our returns come from trading. So we're trading very frequently, all day, every day, literally hundreds and hundreds of trades a week.
All right. Some great insights there. Gopi, Karunakaran, thank you for joining us from Ardea Investment Management. And thank you for joining us. If you enjoyed that video, why don't you go subscribe to the Livewire and Market Index websites, as well as our YouTube channel. Thanks for watching.